number 1, if you are ready. The group can present right now for question number 1. No problem, take your time. Today we should be able to end earlier lah. Should be able to. Okay. Wing Seong, yeah, I'm looking on your screen. You may continue. You may proceed.
Okay, so for question 1, EcoGreen Group is a Bursa Malaysia listed real estate developer. Its real estate developer projects are mainly located in the Klang Valley and Johor Bahru. It is interested to acquire Masing Sdn Bhd, which is a smaller real estate developer in Klang Valley involved in building works of medium-sized resident properties. The director of EcoGreen would like to know the value of Masing before acquisition. Payout share capital of Masing consists of 10 million ordinary share of RM1 each, and the retained earning include the latest profit after tax is 4 million. The profit after tax was 1 million in the latest year. Masing has just paid 50%, 500k of its recent profit after tax as dividend to its shareholder. It is estimated that the dividend growth rate will be 5% per year for the next 2 years, and the growth will tap down to 4% per year for the foreseeable future. A least proxy company with similar business as Masing has a price earning multiple of 12 times. The cost of equity of Masing is 10%. So for the first question, calculate a range of value in total and per share for the share of Masing by using the following method of share valuation. For the first method is net asset value method. So the formula is payout share capital plus retained earning, then divide by the number of shares. So it will be 10 million plus 4 million, then add all together and divide by 10 million. So it's RM4 1.4 per share. So I will pass the next method to another presenter.
Wing now is the price earning, is it?
Yeah, correct.
Yeah. So for price earning method is we using the price earning ratios that given in the questions, multiply with the net profits after taxations, and the total divide by the number of shares. So the answer is 12 times multiply RM1 million divide by 10 million of shares, which is RM 1.2 per shares. And following by the dividend growth methods, so for these questions, we couldn't do it because we have used another ways is the cash flow method, but also couldn't find the answer. We're confused of it.
Cash flow method couldn't find the answer, but it seems like your dividend growth model. Okay, because there are. Oh, okay. I know which part you did wrongly already. It's okay. Never mind. You just continue first. Later, I will expand on that part.
Okay, thank you, sir.
Okay, no problem.
Next. So following by the
wait. Can you I missed the previous slide. Okay, let me No. After that, we have one slide for the table. Okay, let me look on that. It's correct, man. I think the what you call that? The answer 0.8829 is correct.
Oh, okay.
It's correct. It's correct. This one is correct. This one is correct.
Oh, okay.
So it's okay. Later I explain that.
Okay.
You may continue. No problem.
Next. So next question is identify one share valuations method which is not listed in part A above and discuss two limitations of the selected share valuations. First of the share valuation method is discounted cash flow. There is difficulty on forecasting the growth in future cash flow and financing needs in all future years. Susceptible to errors, as the approximations of future cash flow could be based on accounting profits, which is prepared using the accrual methods of accounting. Yeah. Next presenter.
Okay, maybe we are on hold first. Okay, I will explain the previous part first. Okay, A and B first. All right. That one we keep it later. If you don't mind, Wei Rong, I take over your screen now. Okay. Later you share it again. We talk about A and B first. All right, we are looking on my screen right now. So back to the question. All right. Okay, so basically this is a question. This is a past year questions. I cannot recall, is it last semester or last 2 semesters? So basically we have a company right now, is a public listed company, which is going to take over another company, which is Maheng. All right, it's a Sdn Bhd Maheng. So before the acquisition, so Eco Green would like to have variations, okay, would like to perform a variations analysis on this Maheng in order to see what will be the price that should offer if they want to take over Maheng. All right. So basically, the question requires you all to calculate 3 methods. Net asset value method, this one is extremely simple. We will be just using the total equity, so it will be 10 million capital. Okay, that one is share capital, so it's under equity, plus the retained earnings also under equity. So it's total 14 million. But when you look at that, in total and per share, so in total is 14 million, while per share is 14 million divided by, you have 10 million share, so divided by 10 million, you get 1.4. As simple as that. PE also extremely simple. We will be just using the earnings, okay, because you can do it in total or per share. If in total is the total earnings for that year is 1 million times the proxy is 12. So 1 times 12, then will be 12 million. If you want to do it in share, one will be the 12 million divided by 10 million shares, so it's 1.2. So basically, I think first and second will be very simple for you to score. No issue on that. Okay. So now the problem is the third one, okay, dividend growth model. So first of all, you all must understand that when this is a dividend growth model, we should not base on cash flows. It has nothing to do with cash flows. If the question give you whatever cash flows all these things as long as it is not a dividend, don't include in this model, because like what I told you all before, if you are going to apply this method, make sure that you are using dividend. It is based on the future dividend you receive. You convert to a present value. All right. So from here, actually your answer has already shown us. Just now you can see this one. All of you try to read this one. Maheng has just paid 50% of its recent profit after tax, which is referring to this one, recent profit after tax, 1 million. Okay, 50% of that as dividend to its shareholders, which means, back to here, this one. Okay. Year 1, year 2, year 3, year 4, and until forever. Because business is always until forever. So now what I know is the recent current profit after tax is basically 1 million. But we are not interested on this profit. Even though this one is, the question tell you is a free cash flow. We are not interested on this one, because now what we are going to calculate is the dividend based on dividend model. So we don't want cash flow, we don't want profit, we want dividend. And from the question just now, we will understand that the question said 50% of the earnings will be dividend payment, recent dividend, which means your year 0 dividend is 500,000. And this is the dividend. Can understand? This is the dividend that you will get. All right. And the next step will be here. Okay, so we know that this one, I think all of you can follow. It means that year 0 just paid, so it's year 0. Lo. Current dividend is 500,000. Okay, for the whole company, 500,000 in total. If you want to be per share also can one, you use the 500,000 divided by 10 million. But we can do it in total first. Then at the end only divided by 10 million shares also can. So I use 500,000. Here you all can understand. And it is estimated that the dividend growth rate will be 5% per year for the next 2 years only. Then the growth will taper down to 4%, which will be reduced to only 4% for the foreseeable future. When I say foreseeable future, it means that in the future also 4% until forever. All right? Okay, which means, come back to here. Basically, I'm telling you, first 2 years, growth is 5% per year, per annum. After year 2, until forever, is 4% per annum, until forever. So far, so good, Alright? So just now, I cannot recall the name of the student already, sorry, okay? Just now the students has shown us that, I think he used this formula, PO equal to D1 divided by KE minus G. Okay, so I think I cannot recall whether he times 1.05 or not, because as you know, this one is D1. D0, I think I told you all many times, don't use D0 because if we invest today, the 500,000, can you get that? You can't get that because it has already been paid out. Okay, remember the concept. Anything that if I purchase, I want to know the value of this company. If I take over the whole company, the 500,000 I cannot get one, has already been paid out. That one is the current dividend. So the dividend I will get will be next year. Okay, so here I need to times 1.05 because 5% per year. 500,000 times 1.05 is 525,000 here. Can follow? Because every year the dividend will grow another 5% from the question. All right, and this one is no longer useful because this 500,000 we cannot get one. This 500,000, if we take over the company, whole company today, we cannot get a 500,000 right now. Has already been paid out to the previous shareholders. Okay, you can think like that. Or like the concept I told you all, you buy something today, you invest something today, like you place a FD, fixed deposit. The interest you get will be next year only get. It won't be this year one. All right, can understand the logic. I think just now the students apply this one. So 525 very simple, divided by KE. KE from the question given, cost of equity is 10%. So it's 0.1 minus 0.05, right? If not mistaken, that's what I saw.
But then, sir, if we change the D1 to 525K, right? Then the answer will be different already.
Yeah, this one is wrong.
Oh, okay.
This one is wrong. This one, I'm just showing that why you did it wrongly. I try to explain that. Okay. So this is wrong. This is wrong.
We couldn't use this formula to apply on this question.
We will be using this formula, but not directly. You know, because the problem here is what? The problem here is when you're applying this formula, okay, when you're applying this formula, you must make sure that the growth rate, it continues to grow, at this rate until forever. But when you look at this timeline, can you see something's wrong here?
Yes.
This growth rate only 5% per annum, only 2 years only. Then after that will be 4% already, until forever. Which means that we cannot apply this one.
If let's say we are starting from year 2, then only we could apply this formula.
Yes, you are right. So after year 2, then we only apply this formula. Then there will be nothing wrong because after year 2 will be until forever. Then meet its conditions, then we can use this formula.
The condition, if the growth rate is constant.
Yes, that's right. Because when you are applying this formula, this is what we call the constant dividend growth formula. So we need to assume that the dividend will be continue to grow every year until forever at a constant rate. At a constant rate, you cannot be the growth rate, up and down like 4%, 5% cannot. We can only allow one constant rate. So that's why just now, if you base on this formula, it's actually wrong because we have two growth rate right now, and the 5% is actually only 2 years, not forever. Can understand? Any question you may ask?
No, actually I found a cumulative calculation also, but then I don't know how many years that I need to calculate.
Or cumulative one will be impossible to do actually. Like what I told you, because it's forever, it's forever. So you cannot be like year 5, year 6, year 7, year 8, 10 will be endless already your calculation. So that's why we need to use this method. Because actually, if let's say this one is also 5%, it means this question we have only one growth rate. It's telling you, here is 5,000 until forever also 5%, every year 5%. Then you use this formula is correct. Your answer will be correct. Because this formula basically is to calculate that when you have it can be dividend, it can be cash flow. When you have a dividend or cash flow that will be growing at a constant rate until forever, then you want to have a presence value right now. You use this formula, it will give you the presence value right now. Which means that if you convert everything in the future, the cash flow back to a current value, then you will be able to do so by using this formula.
Which means this growth model is not only applicable on the dividend.
Yes, the cash flow also you can use this method, but you make sure that when you are using discounted cash flow method, this is cash flow, not dividend. That's all.
Okay.
So as long as this one is cash flow, then you apply the same thing. Just that this one you change to CF1. So when because this is dividend model, now we are doing dividend model, and make sure that this one is dividend.
So the growth rate also need to be cash flow one, right?
Yeah, that's right. The question will tell you very clearly. Like you see the past year question, this one. You see, this one I will tell you very clearly. This one is dividend growth rate. Because do not be surprised. Sometimes will be only the cash flow that assume that there will be a growth rate for the cash flow, but dividend remain constant is possible one. Because you try to ask yourself, sometimes the company policy, it could be the company is growing, so the cash flow, the receive free cash flow expected to increase every year. But when come to their dividend policy, they can choose to remain constant. The dividend, they don't want to pay, even that they receive more and more cash in the future, expected to receive more and more. But they still want to remain constant, the dividend. Every year, 1 ringgit per share. Nothing wrong on that. You understand? Okay. So that's why you need to be very clear on the growth rate. Is it for the cash flow or for the dividend?
Which means even though the cash flow increasing every year, but then the growth rate for the dividend we just remain at a certain percentage.
Which means that it could be 2. The question can give you the growth rate for the cash flow is 4%, while the growth for the dividend like this one is 5%. So that's why when you are applying discounted cash flow model, the G is 4%. When you are applying dividend model, then will be 5%. It could be different one.
Okay, understood.
Understood. Okay, good.
All right, thank you.
Okay, good question. If you have any question, please ask me. It's good. Okay. That's the purpose of tutorial class, actually, to have more discussions. If you see anything don't understand, you can ask directly. All right, I appreciate that also. Okay, so we continue. So that's why this one we cannot apply directly. Like what I explained, it is because it is not a constant growth rate. Like what I said, if the question tells you it's only one growth rate, 5% per annum until forever, yes, then you can apply this formula. 525K divided by 0.05, immediately you get the answer. It's the current value of the company based on dividend model. But the problem now is 2 years later, it becomes 4%. Which means that we cannot use this one. Like what the student showed us just now. Is wrong, because this 5% is not forever. It's only 2 years only. 5%, 2 years only. So we cannot apply this one. So what we can do right now, no worry. So what we can do right now, first of all, we calculate one by one first. So 525 times 1.05 again is 551.25 thousand. All right. And after that, you know, after that will be only 4%. So 551.25 times 1.04. 551.25 times 1.04. It is 573. Of course, if you want to calculate, you can continue, but pointless lah, because forever until forever you have year 5, year 6, year 7 until year 1000. You cannot calculate one by one. So basically we stop here. Alright, basically we stop here. We'll do. Okay, so now what we are going to do, we use the NPV method. Okay, you remember the NPV method, Year, and here usually is cash flow. But because we are using dividend model, so we need to change to dividend. We base on dividend, not cash flow. Alright, discount factor 10% from the question, cost of equity. And for the last one will be the, you can say it's present value of dividend. Or you can just put present value will do. So, okay, we have year, because year 0 are other things. Okay, we start from year 1 and year 2. So in here, we will have the dividend that we are going to receive. If we take over this company right now, so the dividend that we are going to receive in the next 2 years will be 525,000. 525,000, right? And 551.25 thousand. Alright, can understand? So I have already received these two in the table. So I erase that. Okay. Now, after 2 years, after we pass 2 years, we receive 2 dividends from the company. Then from here onward, okay, then you notice some things. Right now, year 2 onwards, we have only 1 growth rate, which means from here onward, because we cannot calculate one by one, 3, 4, 5, 6, impossible. Okay, it's until forever one. So from here onward, no worry, then we can apply the dividend growth model. It is just that, just now the formula is like that. KE minus G minus Z. P0 is at here, year 0. But now we are at year 2 minus Z after we receive the dividend. So our P, it will become P2, which means that it's the value of this, market value of this share price at year 2 here. Alright? Equals to, so you can, same theories applies just like P0. If you can think like that, if you sell this company out at year 2, okay, to a new buyer, the new buyer use this formula also. So for the new buyer, if he or she is going to purchase from you, the first dividend the new buyer will get is the dividend tree, D3, divided by KE minus G. Because the new buyer unable to get the year 2, year 2 you get already, then you only sell, right? So that's why this is the, the nearest, the next dividend that the new buyer is going to get if the new buyer purchase from you again, the company. You can think like that actually. Which means you can think like, if I purchase or take over this company, okay, I hold only for 2 years. So the first year I get this one, second year I get this one. After second year, right after I get the dividend, I sell the company. So how much I can sell? So after second year, you still have all these cash flows. So if there's a new buyer, the new buyer can use this method at P2 and then calculate. Same thing. So equals to D3 is 573.3K. We have D3 divided by KE 0.1 minus 0.04. And we can apply this formula right now, because after year 2, the G is 4% until forever. Every year increase 4%. If you want to calculate, you use this one times 1.04, then you get this one, and this one times 1.04 until forever. But you cannot do that. So that's why we use this formula. This formula will be able to convert everything in the future back to a present value, which in this case is, I think, 573.3 divided by 0.06 is 9555K. Okay, which means at year 2, if after you receive this one, you sell at the same timing, it's not year 3 because it's here, it's P2, it's here. So you can sell it for 9555K. Actually, this amount, 9555K, equals to all the future cash flow already, converted to the present value at year 2. Okay, but we haven't finished, because what we are interested is actually what? Is actually P0, not P2. This one is P2. And this one is all the cash flow that you receive. So the last step will be, we are going to use the DF 10% is 0.9091. If you go to refer to the discount table A3 and 0.8264. And this one also 0.8264. Second year at this timing, then you times accordingly, times, add everything up, then that one is your answer for the current share price. Because when you are applying, when you times the discount factor, it means that you are converting all the future cash flow to a present value here. We only want the present value right now. It worth berapa. So that's why we are doing that. Then you will get this answer, which actually just now in the slide you did it correctly. The answer is this one. Okay, I give you maybe 1 or 2 minutes for this one. Like what I said, is a very, very common question in the exam. So please make sure you know how to calculate. It could be like what I told you, dividend growth model and the cash flow model, they are exactly the same one. Exactly the same. In terms of formula, they are exactly the same. The only difference is dividend model, we use dividend. Cash flow model, we use cash flow, that's all. In terms of calculation, they are exactly the same. They are also discounted model actually. It's also, whatever we get in the future, we convert that back to a present value, that's all. Any question? Feel free to ask. So don't be confused. I know that you are confused because in the lecture notes, when we apply this one is for the cash flow, right? In the lecture notes is cash flow. But like what I told you all before last week, it can apply to dividend also. It's the same, exactly the same. The way exactly the same. Just that one is dividend, one is cash flow. And stay tuned now, okay? Because very fast, I think not so fast also. Next few weeks, when you come to NPV, net present value calculation, capital budgeting, the one for investment one, I will explain to you why do we need to convert to a present value. The logic behind or the reason behind. Because now maybe you don't understand why need to convert to, what does it mean by convert, discount back to present value. Why is it so important need to discount? I will explain that later. But now I just want you all to understand how to apply the formula, how to use the formula to get the answer. Okay? So far, no question, Clear, okay. Good, so we will continue right now. Before we continue, and just now the last sub question is actually about this one, efficient market hypothesis, which is a very interesting theory actually. If in the future you want to invest in share market, trust me, actually this one is a very important theory that you must understand. Okay, even though it's a very old theory, but until today I think it still applies. Okay, actually this theory is telling you that basically this theory is telling you that our market is efficient one, which means all the share prices in our market, they are already at their fair price. So don't think that you are so smart that, I'm having more information on this company, or I'm having a better analyzing skills in the share market, so I will be able to earn more than the other. No such thing. Under this efficient market hypothesis saying that no such thing one, because our market is efficient. So that's why whoever, actually someone did a research a long time ago comparing a fund manager, I think it's a fund manager, and then compared to a cat, I think if not mistaken, it's an animal and then they pick the stocks and then they measure the performance over long term. At the end of the day, both also similar the performance. Why? Because of this one. The market itself is efficient. So actually it's very hard for you to earn abnormal return. But of course in here we have 4 types of efficiency. Zero efficiency, saying that share price fails to reflect information. Okay, if your share market is in zero efficiency, it means that all the share prices fail to reflect any information from the market. I give you an example, which means like if you go to a share market and then you invest into a company, you purchase the share, invest into share of this company, and after that the company perform very, very well. Okay, open branches, blah blah blah, grow very fast. Okay, but if the market is in zero efficiency, so sorry, the share price will not react to that. It means that the share price still the same. Maybe you purchase this share at 1 ringgit. After 5 years now, you look at the company, your company of this share, already like growing very, very fast, becomes very, very big, but your share price still 1 ringgit. In that situation, we call that the market is in zero efficiency, not efficient at all. Okay, and we don't want to invest into this kind of market, definitely. Is that waveform is the share price reflects only past information. Okay, past information refers to information that have already happened, must have already happened, then we consider that as a past information. For an example, publish annual report. Okay, in the annual report that you can see that the company has really earned that much of earnings. It has already happened. Then it will be reflected in the share price. Which means that the share price maybe is 1 ringgit. Until you need to wait until 1 ringgit until the company announce or in its annual report it has already earned that much, has already past tense, okay, already earned, then it will be reflected. The share price will go up. This is in wake form. Any past information must happen, not prediction, must happen first. Then only will be reflected in the share price. Okay, semi-strong form will be share price reflects past and public information. Okay, so based on this one, is not I said one, researchers, most of the researchers that have carried out research, and it is proven that our market is not our market. I mean most of the markets in the world are in semi-strong form, which means that the share prices that you look at, okay, from Busan, Malaysia or any other market usually they will reflect not only past information, but also public information, including public expectations. Which means that if you expect something to happen, then it will be reflected. It means in the future one haven't happened. But if most of us expect that it will happen, then it will be reflected in the share price. The share price will go up already. It will not wait until it happens first. It will react first. Any things that likely to happen in the future will be reacted in the share price right now. And most of the markets in the world, they are in this semi-strong form. And if you ask me, I 100% agree on that. I also think that our market is in semi-strong form. This is so important. A little bit of side talk. This is so important that you must understand before you invest into share market. I think a lot of you maybe will hear something like that. Or I give you a simple example for you to think of. Okay? Public bank. Okay, public bank. And I use another slide. PBB, compared to one MeTech. MeTech is a technology company, a quite big technology company in Malaysia, compared to Public Bank. Real case, okay. So MeTech is a very fast growing, with very good prospects in the future, because it's technology company. So usually in technology, for those like technology companies, their prospect is going to be better than the other industry. Like bank, Public Bank, very stable earnings. But in terms of like growing, the growth prospect or the growth rate, usually will be lower. So now I ask you one question, all of you, I ask you one question. If you would to be investing in share market today, which one will you select? You want to select technology companies which they have a very good prospect and growing potential, or you want to invest into like a stable one like Public Bank with stable earnings and it's not expected to like double up your earnings in the future. Which one is better? What do you think? Okay, MeTech, technology companies. Any other any others would like to select Public Bank one? Oh, Public Bank, okay. Silva, any reasons for that? Why do you like Public Bank? But Public Bank, I can tell banking industry is really banking industry in Malaysia. If you look from past 10 years until today, I can tell you not much growing one. Public Bank, I think, is the top performer already. If you look at Maybank, you see, if you look at Maybank, Maybank share price, max 10 years, we are talking about 10 years, from 10 years ago is here, you see 9 ringgit, until today. This one adjusted for all the bonus issues is already a fair price. They have already adjusted. 10 years ago, if you purchase Maybank, you hold until today, any gain you can get. I think it's a loss, 889, 849 until today is like 807, So is there any growth in this company? No, because it's no growth, the banking industry has already been so matured. It has already been stabilized, we call that. It's already matured. So it's very hard for Public Bank, like you ask yourself, can Public Bank over the next 10 years open another? Now I think Public Bank has about 300 branches in Malaysia. Can Public Bank open another 300 branches, become 600 branches 10 years later? Not likely, because banking industry, I think you all know, now even they are saying that they are, the landscape is changing, everything replaced by AI, they are going to downsize, all these things. So that's why in terms of growth rate, if you ask me, I don't think the growth rate will be as good as technology companies. Just want to see why I'm wrong. Okay. That's all from all of you. Okay. Because why do I share with you this? I can tell you, in the future, maybe when you want to invest in share market, definitely a lot of people will be telling you, if you want to invest, definitely we go with technology companies, because technology companies faster. The growth rate will be better than the others industries. Will be the future, is that? But I can tell you, this is a myth. Okay, myth. It means that for me, at least I personally think that this is wrong one. You cannot think like that. Okay, why? I show you some things right now to show that our market is in semi-strong form. Is in semi-strong form. I give you some real figures. So Public Bank, we only need the share price, and then we need the earnings per share, I think. Okay, and we have the PE ratio that you have learned PE ratio, is that? Share price for Public Bank right now is 4.09. Earnings per share, one share can earn 0.2613. So the PE is about 15.65 times. Real figures from the market right now. MeTech, MeTech, now the share price per share is 3.6. Okay. Earnings per share is 0.0573. So the PE is 62.82. Okay. In here, I just want to tell you that if you are still thinking technologies, if I go to the market today, I invest in technology will be the best choice. I can tell you, based on my perspective, you are wrong. Okay, why? Because our market is in semi-strong form. For a very common predictions, like this kind of technologies companies, they are going to grow very fast in the future. Everyone knows that. So when everyone knows that, what will happen is they have already purchased. So when you look at that, the share price pretty similar. Can you see that public bank for right now per share, if you purchase the share of public bank 4.09 per share can earn you 0.2613, 26 cents per share every year. Okay, so if you use this divided by this, is about 15.65 times that, which means if in the future public bank continues to earn this kind of money, 15 years later you will get back all your money, 4.09, and after that will be all pure earnings. Can understand what I'm trying to tell? If you buy the share today, you pay 4.09, 4 ringgit today. Every year, public bank can earn you 26 cents. So it takes you about 15, 16 years to get back all the money. All right? Fair, okay? When you come to MeTech, share price 3.6. Now, at each share, every year can only earn you about 6 cents only, you know. So if MeTech continues to earn only 6 cents, it takes you about 63 years to get back all your money. But of course, why they are willing to pay such a high price? Because if you look at that, this one is extremely expensive, you know, the share price. This company per share only earn now only 6 cents. You pay 3.6 ringgit to buy a company which now every year based on the latest EPS only earn 6 cents per share. Then you pay 3 ringgit something to buy the 6 cents per earning. Do you think that is it expensive? This one I have no comment. I'm not saying that technologies companies they are not good, because like what I said, the market is already fair by its own. When these kind of companies that have a very, very fast growing potential, it has already been reflected. You see only 6 cents earnings, people pay 3.6 ringgit to purchase, you know. Because people thinking that hey, these earnings will increase in the future one. It will not be 6 cents, it will be more and more. They have a better growth potential, so that all of them go to purchase one, and then the share price will be so high right now. The PE is 62 times, you know. Can you see this one? Actually, this can prove our market is in semi-strong form. Because if our market is not in semi-strong form, they haven't earned one, like MeTech in the future, wow, very fast growing, all these things, earn a lot of money. If our market is not in semi-strong form, is in weak form, it will not be reflected one. Then the share price should be very, very low. It should be quite similar to this one, also 15.65. So which means that the share price should be only 0.0573 times 15.65. The share price should be only 0.90. If our market is in weak form, this should be what happened. Okay, because the share price will not reflect any future or public expectation. It will only reflect whatever that have already happened, like the latest EPS. So this two is the same. So if in weak form, then you can tell me, like in this one is really, I can tell you, wow, this one definitely better. Why? Because this one cannot grow already one. But this one, I can tell you definitely lesser than 15 years later on, because this one can still grow very fast. The EPS now is only 90 cents, you know. Wow, quickly go to buy. But now the case is what? When you look at our market, this is 3.6 already. Okay? And the PE is 63 times, you know. Which means it's very expensive. Or I cannot say it's very expensive. I would like to say that it's a very high level, the price at a very high level. due to its better prospects in the future. So if you buy this one, do you think that you can earn faster than PPB, public bank? There's a question mark. I'm not saying that it can't, but there is a question mark. In my eye, or based on this semi-strong form, theory, they will give you the same return. You invest in public bank, you invest in MeTech, they will give you the same return. Because public bank now, it takes you only maybe 15, 16 years to get back all your money. If you invest in MeTech, I think even though this one is fast growing, if you grow, but when you calculate, maybe also 15, 16 years, you can only cover back whatever you have invested into the company. So that's why this one, it proved that our market reflects future expectations. So don't think that you are so smart, you can predict technology companies is better because they can grow faster. So when I invest only in technology companies. This kind of thought, actually something's wrong. Because the market has already reflected that. You see the share price? Not only this one, not only MeTech, I can tell you. All the technology companies, in average, their PE also 50, 61. In average, 50 times. So they are already at a very high level, their price. Which reflects, because why people willing to pay such a high price for these kind of companies? Because all people expect they will be performing very well. So they will not wait until they perform very well, they only go to buy. They will buy right now. Can understand? Okay, so this is a proof that I can show you our market is in semi-strong form. All right, and strong form is the perfect form. This one share price reflects all information, including this one, including past, public expectation, and one more, which is insider information. This is the perfect form, and basically it does not assist. If you ask me, based on my personal perspective, I also don't think that, because you see, insider I think I told you last week, if you want the share price to go up or go down, you must have investor actions in between, buy or sell. Okay, and this strong form is saying that even you have insider information, you are the top management. After your meeting, you all have decided to do something. It's a good news. Okay, no people knows yet. You all haven't buy the share, but after you have the insider information, you should be the first one to know that. When you go to the market, you want to buy, the share price already gone up. Because the share price has already reflected this insider information, which actually realistically is impossible. So if you have insider information, usually you still can earn. Because no people knows, no people go to buy. You are the first one to know, you buy first. Then when the news release already becomes public information, everyone knows already, then they will go to buy, then the share price goes up. You are the first one to buy at a low price. So you can earn something. So in semi-strong form, usually if you want to earn abnormal return, more than the others one, you must have insider information. If the market is in strong form, it's already perfect, the market. So in a perfect market, no one can earn abnormal return. No one. Okay, I don't care you are a stock analyst. Compared to a dog, the dog go to pick the stocks. At the end, your return should be similar. Okay, no one will be able to earn anything extra. They still can earn. Don't get me wrong, they still can earn. It's just that, like just now I show you the case. This one takes 15 years, that one also takes 15 years. So it's fair. Okay, you can only earn a fair return because the market is already efficient by its own. Actually, it makes sense if you think about that. It makes sense. Semi-strong and strong form, it makes sense because you don't think that you can beat the market. The share price decided by so many investors. How could you say that? No, this one undervalued. Trust me, because based on my analysis, this one will be in the future, it will get more on this on that then you base on that to buy. But you need to think of one thing. Maybe whatever you are thinking right now, your thoughts already inside the share price, already reflected in the share price. So you think that it's cheap. Actually, it's not cheap. It has already reflected whatever you are thinking. Okay, so not easy. You want to earn money from the share market. especially when you're talking about abnormal return. Like, extraordinary return is not easy. All right. So I think I explained too much. So I think you can continue to present the 1C. Yeah, stop to present my screen.
Hi sir, I'll be presenting this question.
Okay, Sian.
Should I read the question?
Yeah, you may read the question because it's very short. Okay lah.
Okay, so assuming that Eco Green has decided to take over Mahing because the acquisition will benefit both companies due to synergistic effects, the Chief Financial Officer of Eco Green has informed his cousin, Tony, to invest in the shares of Eco Green before the good news is released. Assuming that the share market is in a strong market efficiency form, Tony would be able to earn abnormal returns if he were to invest in the shares of Eco Green before the news is released to the public. Discuss the above statement and support your discussion with proper justification. So based on the first assumption, the Chief Financial Officer CFO of Eco Green had given an insider information to his cousin Tony and informed him to acquire the company shares before the news is released. So insider information means material and non-public information that can influence a reasonable investor in buying or selling the shares. So as a CFO, such information should not be communicated to anyone, including their spouses, relatives, and friends, as this would be considered insider trading and it's not legal. So under the Capital Market and Services Act 2007, if they are found guilty of this will result in a jail term up to 10 years and a fine of not less than 1 million. But I also saw that it can also be legal if when the company insider engage in trading company stock, as long as they report these trades to the Securities Commission, SEC. But in this case, they did not, so it will be not legal. So the second assumption is assuming that this market is in a strong market efficiency form. This means that the share price will reflect only on public information and past information as well as insider information. Thus, in this efficiency market, the share prices will respond to new developments and events before they even become public knowledge. So, Tony will not be able to earn abnormal returns despite having insider information regarding the acquisition of Mahing, as the information has already been reflected in the share price. Yeah, that's all from me, sir.
Okay, Sian, thank you very much. Okay, a very good answer. Maybe you can show your answer again over there. Okay, actually, I did not expect you all to also share those insider informations. Because of this will be based on assumption that he would be able to do so. But that answer is nothing wrong. If you write something like that, I think I will give you marks also, which actually is also one of the facts okay. Supposingly, it's not allowed. Okay, unless like Sian said, they need to you will be able to see the announcement that the CEO saying that in the next 2 weeks you really have this sort of announcement one. They will make an announcement saying that in the next 2 weeks I'm going to have actions. Usually I think they use actions, okay, on the share market to either purchase or sell. The directors or the bigger shareholders usually they have this sort of announcement to inform everyone. Okay, I'm going to buy already. Okay, but basically okay, generally they cannot use the insider information for their personal benefits. It's usually they want to buy or they want to sell, they must be able to justify themselves to Security Commission that I'm not because of this news that I only go to buy. Then we'll be all right one. And usually any actions from the biggest shareholders, any action, because when they buy will be a very huge amount. It won't be only 50,000, 100,000. When they buy is really like 10 million, 20 million one, then it will have a huge impact on the share price, okay, on that particular share. So usually they will make announcement first. They will inform all the shareholders first. I am going to do something, either buy or sell, okay. Usually they will not say I'm going to buy. No such thing. They will only say that I will have some actions on my shareholdings in the coming few days or 2 weeks. That's the announcement you all will be able to see. So it could be buying or it could be selling. If you are the shareholders, so when you listen to that, you make your own decisions. You can sell it right now, because you do not know if the bigger shareholders is buying one, then congratulations, because when they buy a lot, share price go up one. But if opposite way, they sell, they throw their shares. I mute my okay, I mute my phone first, sorry for that. So if they sell, you are going to have a loss, because when they throw, we call it throw, when they sell the shares, they sell a lot, the share price will go down. So usually they will make an announcement telling all of the shareholders, I will have some action. You have your own call, you want to sell, you sell right now. Because it could be buying, it could be selling, you do not know. Okay, and back to here, your second paragraph actually is my answer, is the formal answer, very good. So the second paragraph is saying that it's a strong market efficiency form, which means that Tony would not be able to earn any abnormal returns, okay, because the market is in strong form. So even though after the CEO, after the meetings, and then the CEO informs the persons, assume that it's legal, and then Tony goes to buy the shares of this company, is already too late, because based on strong form efficiency, whatever the insider information, even though has yet to be released, the share price already reflected, which actually is impossible, but if in strong form, if you happen like that, so no one can earn any abnormal return one, regardless who you are. You are the CEO, you have the insider information, I let you to trade, you also cannot earn anything, because once this insider information is going to happen it will be reflected in the share price immediately. When you go to buy, like before the meeting is 1 ringgit maybe. Before the meeting haven't happened, 1 ringgit. After the meeting, we decided insider information, we will get a project from government, very profitable. And after the meeting, only maybe few of the directors know, they go to buy also too late. When you look at the share price already 1.2, which actually is impossible. It's impossible because no one knows, no one go to buy, the share price will not go up. But strong market efficiency form is telling that no, it will be reflected like that. Actually, there is another argument. I will share my answer here. I will take over your screen. Right. Okay, for the answer, very short only for the 5 marks. Okay, that's what I explained, so would not be able to earn. Actually, there is another argument, for the supporters of this strong form efficiency. Some researchers that think that the markets actually they are in strong form efficiency, because they argue that even if someone able to do that, it will not be consistent one. Like if you read this one, even if he does in this event, like Tony would be able to earn abnormal return, but he will not be able to do it consistently in the long term. And it is impossible for him to consistently obtain insider information from other companies in the long term. This is another argument supporting strong form efficiency one. Because then we do have some of the researchers that support our markets actually are in strong form efficiency. And they also admit, yes, someone with insider information can earn abnormal return, but it is still in strong form. Because even they can do it 1 time, 2 times, they cannot always do that one in long term. Because it's impossible you get all the insider information from all the companies. So that's why in long term, basically everyone will be still getting the fair return, average return only, because the share price have already reflected everything. Okay? Okay, I think that's all for question 1. We will have a 3 minutes break. If you have any question, can ask me, then we will continue. Huh? Today is 11079. GG lor. It's really endless one, this case.
Sir, I would like to ask some coursework thing, like for our division dividend policy. We just mentioned out what's the dividend policy that's the company give, is it? Then explain about what?
Okay.
Like for dividend.
Okay, basically for the dividend policy, so first of all, you must understand some companies, they will have their own dividend policy declared to the public. They will tell the public, like Top Glove, for example, it declares that, we will pay 70% from our earnings as dividend in the future to our shareholders. Okay, so this one is a very clear dividend policy being declared to the public. But some companies, don't be surprised, maybe the company selected by you go to file, you cannot see anything about dividend policy one, because the company does not have a dividend policy, which actually is also a dividend policy, which means that it's a very flexible dividend policy. The company does not want to restrict itself from giving dividend. It's also possible. So you try to look for that. If you look at the company is trying to maintain a fixed dividend payout policy, like the company will say 40% of our earnings will be paid out as dividend in the future. That's our plan, our dividend policy. And this kind of dividend policy, there will be advantages and disadvantages. You can talk about that. Advantages will be if you have a very stable dividends, then your stock can be claimed as an income stock, which you can attract certain investors to invest into your company one. For those like, that prefer to receive some dividend every year one, then they will invest your company, so the share price will go up based on that.
So then can we give suggestion on the dividend policy?
Yeah, can. But that one will be in your
okay.
But that one will be in your individual assignment already. It's not in your group assignment.
Individual.
Yeah, individual.
In group assignment, it says by using these dividend policies, what the company will gain, is it advantage of this dividend
yes,
policy?
advantages and disadvantages.
And this advantage and disadvantage only lah.
Yes, that's all only.
Okay, thank you, sir.
Okay, no problem. Because for example, even though your company does not have a we call it very explicit dividend policy, you cannot tell from the annual report data, from announcement data. Okay, so which means that it's a very flexible dividend policy. It does not have a very clear dividend policy. You can also talk about that. So the advantages is what? The advantages will be, you see, when a company does not have a clear dividend policy, so the company will be very flexible in using its earnings for reinvestment. The company, whenever you have earnings, you have full control on that. You want to use, when you have a very good projects, good investment, keep all the earnings for reinvestment. You don't want to pay dividend because no one will expect you to pay. Your shareholders will not have that kind of expectation. I do not have a dividend policy, so I'm very flexible. I can do whatever I want every year when I have earnings. So that's the advantages. That's one of the advantages. When it comes to disadvantages, will be some shareholders will question that. Why you have earnings, you don't want to pay me dividend? Why you don't want to pay dividends? You keep all the earnings for what? So this one will be the disadvantage. Okay, if you have a very flexible dividend policy or you don't pay dividend at all, then some shareholders or investors, when you come to fundraising, they are not interested in your company. They don't want to invest in your company because your company because some investor that prefer dividend one, they want to invest into a good company. This company earns money every year, then they get back something every year. That's what they want. So if your company does not pay any dividend, when come to fundraising, you want to raise fund, they don't want to invest in your company. They don't want to buy your share. So this is the disadvantage. So there will be good and bad. I believe that if you type, if you know that the dividend policy of the company, a fixed dividend payout policy, you type on Google advantages and disadvantages of fixed dividend payout policy, boom, all the answers are there. Then you can explain. All right. Or another way will be, if you really do not know how does this company, there's no explicit dividend policy, then you can look at its past, past dividend payment. So is it constant? Maybe you can look at the past 3 years or past 5 years. Is it quite constant one? If quite constant one, then even though they did not tell you, the company does not have a clear dividend policy, but you can base on the historical data to talk about that. So based on the past 5 years, it's very constant. Every year is about 10 cents to 13 cents per year. So I would say that this one is a constant dividend payment policy. Then you talk about advantages and disadvantages. Okay, so Jian Wei asking. No need. Jian Wei, you just talk about what are the current investing activities you will do. You don't really need to talk about what are the advantages, okay, of all these investments. I don't think you need to do that. Because remember, when, okay, the higher level you get when come to this kind of, not only for this assignment, in the future also the same. When come to analysis or because when you read the questions of the assignment, it does not ask for your own opinion or recommendations. Remember one thing, very important. You just talk about the facts and findings. Try not to put too many own assumptions. Like maybe you see this kind of investment like, oh, the company is going to open a branch or expand the business to overseas. Then from there, unless you have any news saying that, oh, their expected return is berapa, expected profitability berapa, then you can include in your assignment. If there is no such information, don't try to guess yourself. Don't try to say that, I think it's a very good investment. No need. Okay, at a higher level unless the question asking your own opinion or your suggestions, all these things. If not, based on facts. Based on facts, it means that you just talk about your findings and facts. Okay. Junning said that, what if my selected company does not have equity financings? Can I just talk about long-term debt at least? Junning, trust me, 100%, all the companies will have equity financing for sure. Okay, for sure. Because in order to, to become a company, you must have shareholders, you must have equity financing, you must have owners in order to have that company. So it's impossible. When you go to your, when you go to your, what you call that, the SOFP, the statement of financial positions of your company, definitely your equity, you have items. If you can find any public listed companies under equity kosong one, you come back to find me, I pay you 100 ringgit for that. Okay, if you can find any 1,000 plus companies in Malaysia, any company under equity, the other one kosong one, you come back to me. Okay, it's impossible. Must have something one. Maybe it does not have the latest one, but you can talk about is the current financing. I mean the sources of finance the company is having. Yeah, Gemma, you can do that if you want. Okay, Jen Pink, I would actually both also can. You can refer to either one, but I would say that group one is better because group one usually you have more sources of finance to discuss. While the company, the difference actually is only that company is based on that company only. Okay, like for example, Genting Berhad. Genting Berhad, it has so many subsidiaries, Genting Plantation apa also under Genting Berhad. Genting Singapore, I mean also under Genting Berhad, I think about 50% of the shareholdings. So the group refers to everything, including the subsidiaries one. Now, if you are only refer to the company, it's only Genting Berhad, excluding all the subsidiaries. So it will be lesser items. I think group is better. You have more things to discuss. Okay, I think we continue first for our last question, even though it's a short one. Then if we have time, we can discuss about the assignment. I think the last question, I think the group can present right now, directly. Okay, so Sukman is presenting.
And I'm going to present this question. Calculate the value of Danaco company using the following method: PE ratio model. Under PE ratio method, we need to calculate the share price using the formula PE ratio times EPS. The PE ratio has already been given in the question is 10 and the EPS is 0.4. So we will get 4 ringgit per share. And the total value of 5 million share is equal to 4 times 5 million, which is 20 million. Under dividend growth model, the cost of capital is 13% and the payout ratio is equal to dividend per share divided by EPS. So to calculate the current year dividend per share, we need to use the payout ratio times the EPS, which is 0.24 per share. So from the question, we can know the last 2 years dividend per share is 0.22, last 1 year is 0.233, and the current year is 0.24. The next year's dividend is, we assume, is D1. And the growth rate per year, we use the geometric mean to calculate. The end value is 0.24 and the initial value is 0.22 and the end is equal to 2 years. So we will get 4.45% per annum. To calculate the dividend is we use the formula P0 equal to D1 divided by KE minus G, and then we will get 2.95 per share. So the total value of 5 million share is equal to 2.95 times 5 million, which is 14.75 million.
Okay, well done, Xingyi. Hold on, I would like to borrow your slide. Okay, you have done a very, very good job. Okay, which this question is not easy. Can you enlarge that just now for this slide? I just want to show the other students. Okay. All right. Okay, for these questions, actually it's a normal dividend growth model. Okay, the problem of this question, something new is there is no explicit growth rate. It means that from the question, you cannot find the G, the growth rate data. Okay, so whenever you have this kind of case, but the questions is obviously asking you, is the growth model, so definitely there will be a growth rate one. So the growth rate, you need to get that from the past record. Okay, which means that you can see from this question, we have last 2 year, last 1 year, and current year, 24 cents. Which means that we have 3 past dividends, okay, or of the, I think it's the past 2 years, including the current year. So from there, we will be able to find the annual dividend growth rate. And we can assume that in the future also will grow at that rate also. So that's why you can see this one. This one actually I have covered that in chapter 2, if not mistaken, in the lecture class. If you do not know how to calculate, please go back to do your revision in chapter 2. We will be using geometric mean. So as you can see, we will be using the last figure, the current dividend D0, 0.24 divided by 0.22, square root 2, because only 2 times. The growth is only 2 times only. From 0.22 to 0.233 is 1 time. And from 0.233 to 0.24 is another time. So 2 times growth only. So square root is 2. If 3 times, then will be 3 square root. Okay? Then we minus 1 the capital, then we will find the growth rate. So which means that you can think like that. From last 2 years, the dividend payout, 0.22 increase to 0.24. If you average out, the growth rate every year is 4.45%. And we would assume that in the future, the G also 4.45%. That is only one growth rate. Then we have the D1. As you can see the answer there, 0.24 times 1.045. Then you will get the D1 because we expect that in the future, if you grow at that rate also until forever and divided by KE minus G, then easily you will get the answer 2.95. Okay, well done for that. And then you may continue. Thank you.
Discuss the significance to company of the value you have calculated in comparison to the current market value of Danoka company. The current market value of Tanaka is 3.3 times 5 million, which is 16.5 million. So under PE ratio method, the PE ratio indicates the market assessment of a company's future cash flow and risk. The total value under PE ratio method is 20 million, which is greater than the current market value 16.5 million. It may indicate that Tanaka is expected to have a high future growth and low business risk. Under dividend growth model, the current fair value of Tanaka based on dividend growth model is 2.95 per share, which is lower than the current share price 3.3 per share. It may indicate that the current share price of Tanaka is overvalued by 0.35.
Okay, thank you. Hold on first for this slide. Very good. This one, I think you all have tried the answer really is based on your own opinions, okay, or your own findings. But good attempt. But for your PE ratio, I think something's wrong. Your dividend growth model, yeah, you can say so. Okay, so I think I will take over your screen. Thank you for your presentation. But you remember, all of you remember, sorry, yeah, for this slide, open again. I enlarge that again for this slide. Okay, thank you. Okay, so you can see PE ratio. Your group said that it may indicate that Tanaka is expected to have a high future growth and low business risk. This one, something's wrong. Okay, I will explain why to you. All right, so I will take over your screen because it's supposedly based on the variation. It should be turbulent. It should have a low future growth if you want to explain. Okay, I will explain to you right now. I take over your screen. Sokman, thank you. Okay. Okay, actually based on these questions, the Tanaka is a public listed company, is a Berhad public listed company. So the market value of this company is actually 3.3. 3.3 lah. But the question still require us to actually calculate. Because even you have a market value, you still can apply the methods one to calculate like PE and dividend growth model. You still can apply to find that is it consistent with the share price or not. So if you based on PE method, which is using the proxy, if you remember, we are using the proxy, the industry average in this question. We are using like our competitors' average PE to calculate, apply to our company. Our company should worth 4 ringgit, RM4. So if I use PE, it should be RM4. This is the market value, is at Bursa Malaysia, for example. Everyone is, when you are trading right now, is traded at 3.3. PE is 4. And then if you are using the dividend growth model, is 2.95 dividend model. Okay, so the market value, if you look at the questions, question 2, actually we can calculate the PE of this company because we have the earnings per share. Can you see 40 cents, right? If we are using 3.3 divided by 40 cents, then we will have the real PE of the company, which means that the real PE, if I use 3.3 divided by 0.4, is 8.25. Why this one, the share price will be higher if you use the PE methods? It is because these PE methods, if we are using PE variation, we follow the industry average. We use 10 times 0.4. This one is 10 times 0.4. So we get 4 ringgit. But the real price is 3.3, which means that the real PE of the company is actually 8.25 times 0.4, and we get 3.3. Okay. So in this case, the question is asking us, can you discuss why difference one, why tak sama, why the market value 3.3, you use PE method, you get 4 ringgit, which if you trust PE method, this company should be traded at 4 ringgit one, based on the proxy PE. But why now only 3.3? It is because the PE of the company only 8.25. Is lower than the industry. If you follow the industry, it should be 4 ringgit one with that kind of earnings. With 40 cents earnings, like your competitors, if they earn 40 cents, their share price would be 4 ringgit. But now your share price is only 3.3. Why? The question asking you why. You can have two ways of explanation. Is either you can say that, then I think that our company is undervalued. You can say so. If you believe that your company performance is just as good as your competitors, then your explanation can be, why difference is because our company is undervalued. Based on the industry average, our company should have also PE of 10 times. So I think very soon, later on, our share price will become 4 ringgit, just like our competitors, because we do as good as them. Okay, that's one side of explanation. You can expand that. Undervalued, it should be 4 ringgit one, because you see, all the competitors, like when the others that purchase our competitors' share, they are willing to pay 10 times, the PE. Why we only 8.25 times? It's not fair for us, should be also 10 times one. So I think now it's undervalued. You can expand that undervalued difference, because it's undervalued, it's cheap, our share price. Or you can also explain why it's lower. It is because maybe our company, the future growth prospect is lower than the other competitors. So that's why the investors willing to pay 10 times for our competitors. But when it comes to our company, they're only willing to pay 8.25 times, because our future prospect is lower. Or you can extend like that. Can understand? But if you want to justify, because just now your answer is saying that your company is having a higher growth rate, which is actually wrong, because your company is only 8.25 times. The industry is 10 times. So which means that in here is investors, they are willing to pay more for your competitors, because maybe they think that your competitors that can grow better than you. That's why your competitor is 10 times. If you use the 10 times, your share price should be 4 ringgit. But in fact, right now, your share price is only 3.3, because you have a lower PE. All right? Of course, you can justify if you want to say that, no, undervalued. I think our growth rate same one with our competitor. Then you can say, it's undervalued. In the future, it will become 4 ringgit. Also can, no problem. But if you want to justify that, like your answer is saying that the company is having a higher growth rate, I don't see any way you can expand that. If you have any, you can share with me. Why do you think that it's higher growth rate? Because from here, actually, your real PE is only 8.25 times, while the industry is 10 times higher than you, which means that investor willing to pay more, okay, for your competitors compared to you. All right. And then for the dividend model, 2.95 is lower than the market value. So I think you all said that this one is overvalued right now. The real price should be only 2.95, which it could be, okay? It depends on your justification. If you want to say that, you can say that. Because if you believe dividend model is the best model to give you the real value or intrinsic value, then you can justify. I think in this case, dividend model is the best, okay? But you need to base on some facts, maybe from the company there, it tells you it's going to be fixed until forever, all these things. But based on that question, if you want to, based on your answer, I'm not saying that your second answer is wrong. You can say that, but I don't think I will give you full marks, because if you remember, how do you get this answer? You are using the growth rate 4.45%. Remember just now? And this one, how do you get that? You are getting that from historical data, past 3 years historical data, and then you assume that 4.45 times will continue until forever. But can you make sure that this one will happen? until forever? I don't think so, Lord, because actually from the question, I don't think it says anything that if you based on this one until forever, it's only based on our own assumption. Because we must have a growth rate. From the question, the only way to get that is from historical data. We average out. But it's not a very strong figure here. So that's why this one is actually also questionable for me. That's why actually another way of another answer you can say, why difference? Because this one we based on a lot of unrealistic assumptions. So that's why actually this one is not that correct one. It's only a reference. So it's possible, it's different from the market value. You can also expand that, which is correct. Can understand? So that's why, like what I said, it depends on you, how you want to expand. Okay, you can agree or don't agree, but your explanations must be reasonable. Like just now, your answer, good try on that, but your answer, when I read through, something's wrong, because when you are saying that the PE, here you say that the company is having a higher growth perspective. That's why the share price is lower than this one. Then something's wrong, because if you calculate the PE is lower, which means that people think that your company is having a lower growth rate. So that's why your share price is lower due to the lower PE. That should be the correct explanation. You turbulate already. All right. And then for dividend, like what I said, you can say that is now the share price is too high already. If you believe your dividend model is correct model, this is the real value. It should be this one, not this one. Slowly the market will become, the share price will drop until this level. If your dividend model is correct, you need to justify why do you think your dividend model is correct, until you can say that now the share price, like what you mentioned, is overvalued by 35 cents. It's too expensive. Okay, it should be this one. Yes, nothing wrong on that, but you need to be able to justify. I think in your answer, you did not justify why. You just say that it's undervalued 35 cents. But you're unable to explain the 35 cents, why there is such a difference. So like what I said, is either you support your answer, because this one is the best answer, based on what? But from the question, it's pretty hard for you to justify, because your figures is all based on the, the past figures, and then you assume that you continue to grow at that rate. Unless the question shows you some things like, the company has a very stable dividend payout ratio every year, growing at a same rate until forever from the question, then you can justify your answer. Then since it's already written there, then I think this one is the best method already. This should be the price. So which means that now is overvalued. Yeah, can, no problem. Then your answer is correct. I would agree on that. Can get what I mean? It means that for your second part, if I mark your answer, I will still give you marks, but maybe only half, because you're unable to justify your answer. So I will show you the formal answer here. This one I have already explained. Okay, so does not view the growth prospect of your company as favorable as other competitors in the industry. So it's lower actually, your growth prospects, not as good as the others. That's why your share price is lower. So you expand more the case of why the share price lower one based on PE. Because PE you use a proxy 10 times your competitors one. So which means that maybe the shareholders thinking or the investor thinking that your competitors' growth prospect is better than you. So they're willing to pay more. While for you, it's only 8.25 times lower. And the dividend growth, the former answer is saying that, like what I mentioned just now, is different from your answer, but both actually also acceptable one. But this one is more on talking about why difference is because the dividend growth model subject to error one. So it's like assumptions on you can continue to grow at a constant rate, all these things subject to error. So it's not that accurate one actually. That's why definitely there will be a difference if you compare that to the share price, the market value. Okay. All right, I think that's all for the question A. And then we have a question B. Okay, so before I allow you to, I pass the floor to you. So a quick revision. Just now remember the last thing for today is the debt variation value of a bond. So just a quick one, revision. Value of a bond. So how does bond work? Like what I told you, bond is a borrowings. It's a borrowings. So usually, how does it work? Very simple. If I have a CK 3 years bond, maybe 10%. Okay, which means that if today, okay, so in a bond, we have issuer and also bondholder. Issuer is the borrower. Bondholder is the lender. Okay, so in this case, if let's say if you see CK 3 years bond, the issuer is CK company. Let's say it's a corporation. So CK is a Berhad, maybe CK Berhad. So CK is the issuer. CK wants to borrow money. Like I'm the company, I want to borrow money from you. So basically, you lend me the money, right? You lend me the money. So you are the bondholder. In exchange, if you lend me money, I must give you back something. So the something here is the bond. So I will give you a bond, you give me money, you lend me money. So usually the par value of a bond, one bond is 100 ringgit. So if you look at that, 3 years bond, 3 years bond, here, usually one bond is 100. So basically you pay me 100 ringgit, or you lend me 100 ringgit. It's not pay, sorry. I should use lend. You lend me 100 ringgit, I give you one bond. This one, 3 years bond. So you take one bond. So with the bond, you are the bondholder. Every year, I will pay you 10 ringgit as interest, or what we call the coupon payment. Is the interest, because you lend me 100, I pay you 10%, every year 10. All right? And because it's a 3 years bond, at the end of the maturity, I will pay you back the 100 that I borrow from you. Because initially, I borrow from you is 100. At the end, I pay you back 100, then we settle. So if you understand how it works, it is a borrowing actually. It is a borrowing. Can you see? It is a borrowing. You lend 100 to the issuer. The issuer will pay you interest every year. At the end, redeem your bond. When redeem, it means that we pay back the principal, pay you back the 100 at the beginning. So settle already. Understand? So now what do we want is, okay, here, we want to find the present value of this bond. Actually, in this case, if let's say it's a new bond, I can tell you your return is also 10%. We call that yield to maturity, or the market rate. I've explained that in the lecture class. Sometimes it could be different from coupon, but in this case, it's the same. Because why? Just now you remember, you pay 100. It's a new bond, so new bond definitely you pay 100. At the end, you get back 100. So is there any capital gain or capital loss? No, So you pay 100, at the end you get back 100 for that bond. So no gain, no loss. The only return you get is the coupon. Every year 10 ringgit. So that's why your coupon is 10%. The interest you get is 10%. The real return, this one is a real return. The real return you get is also 10%. Okay? So this is the case. I don't want to give you the 100. I want you to calculate the current value. You can do that very simple by using some things that you have learned in your principle of finance, which is this formula, present value. So now I proved to all of you, I can get back this 100 ringgit. I can calculate back. How to do that? Very simple. Present value is, first one, the 100 I want to convert to present value. So this one is only one cash flow. So we use table A3. Present value equal to future value times PVIF. 3 years, this one is 10%. Okay, but haven't finished. We still have this one. And this one, if you remember, is an annuity. Right? Every year, 10 ringgit for 3 years. So plus PMT times PVIFA. 3 years, 10%. Now I want to prove to all of you, we can get back the 100 ringgit one by using this formula. Because this is what we receive. If I buy the bond today, I will receive 100 ringgit 3 years later, and I will receive every year 10 ringgit annuity for 3 years, equal to 100 times PVIF 3 years 10%. Okay, so let's look at the discount table. Table A3, 3 years, 10%, 0.7513. Plus PMT, 10, 10, 10, every year 10 times PV, this one is annuity, so it's table A4. Table A4, present value for annuity, also 3 years, 10%, 2.4869. You all can try to calculate, but I can tell you the answer will be 100, or very near to 100, just because of the decimal point. Maybe it will be slightly different, but I can tell you it is 101 at the end. You can try. You can try to calculate that. You will get back 100. So it's proof that it's correct just now. It's 100. Okay, the present value right now, the value of this bond is 100 based on this cash flow. Okay, that's the way we calculate the current value of a bond. Actually, new bond no need to calculate. New bond definitely is par value 101. But sometimes you must understand, it could be, maybe I give you 1 minute first for you to digest first. Any question you can ask me right now pertaining to this variation of a bond. Actually, I can tell you this one is same with the share variation also, the present value discounted cash flow method. It's also based on the cash flow. We convert all the cash flow to a present value, and the present value is the value of the bond. It's just that bond is easier because bond, if you not be forever, usually, if you not be forever, it will be only, certain 3 years or 5 years, something like that. So it's easier for you to calculate. You can use the table also, NPV method. You draw the table one by one, you year 1, year 2, year 3, also can, up to you. You will get back the same answer. Trust me. It should be the same answer. If you use the table, you cannot get the same answer, then it means that you do it wrongly. You can use the NPV table. Year 1, year 2, year 3. Year 1 is 10. Year 2, 10. Year 3, 100 plus 10, 110. Discount factor 10%, 0.9091, 0.8264, 0.7513. Times, add everything, you get back 100 for sure. You can do that also. But I recommend you all to use this formula because it is faster. 3 years, no problem. If 10 years, you use the table, year 1, year 2, year 3, year 4, year 5, until year 10, then you'll be wasting a lot of time in the exam. So better use this one. Because usually bond, there will be a final value and annuity. Then you add everything up, it will be the present value, as simple as that. Okay? Any question? But again, this one, the yield could be different one. It's not every times 10. Actually, if in the question you look at I can tell you, if you have one question, coupon 10%, the yield, the real return also 10%. You do not need to calculate one, must be 100, I can tell you. Because like what I said, if your coupon is 10, your real return also is 10. Meaning what? Meaning to say that the only return you get from this bond is the coupon. So the coupon is your real return. So that's why your final value and the beginning value must be the same. There is no capital gain or capital loss. But sometimes you will see something like that. You will see the coupon is 10, but the real return is only 8%. Why? Why will be lower one? Because this bond, it could be not a new bond, it's a second-hand bond. You have only 3 years, it could be a 10 years bond. So now remaining only 3 years. So when people sell, when you go to buy, actually you can calculate also, but I lazy to calculate. Let's say the answer, it could be maybe 105. Maybe it's like that. You can calculate to get a real answer. This one is not the real answer. You can do that by change everything to 8%. you have a value. I can tell you definitely more than 100, but I do not know berapa lah. Maybe 105 lah nearby. So this could be the case. You buy a second-hand bond. Why the coupon 10, but your real return 8-1? Very simple. Because coupon, yes, you get 10 ringgit every year, right? 10%. But when you purchase this bond, it's a second-hand bond. When you purchase at 105, which is very expensive. At the end, when you get back, it's only 100. So in here, can you see? You have a loss. You'll be losing 5 ringgit here. So that's why you cannot get back 10% anymore. Your real return will be lower than 10%. It's only 8%. If you understand what I'm trying to tell you right now. So the coupon and the real return, or what we call yield to maturity, it could be different one. Because the bond price can go up and down. It will not be forever 100. All right, but in here, that one a little bit tough lah. In here, you just need to know how to calculate will do. Okay, actually it's very simple, just this formula. And one last thing before I let you to present, I think we will fully utilize the time today also. One last thing, the question actually is a convertible debt. Okay, when we say convertible, actually it's very simple. When you see convertible, it means that at the end of the maturity date, you can choose. You want to convert your bond to certain number of shares. Let's say, maybe you can convert to 20 shares. And at that moment, one share is 6 ringgit and it's 120, which means at the end, at year 3, you can select, after you get the 10 ringgit interest, you can select either you let the company to redeem your bond, you get back only 100, or you don't want to let the company to redeem the bond. You convert your bond into 20 shares, which based on the share price at that time is 120. So which one is better? This one is better, because if you convert to the shares, if both 120, you can sell immediately in the secondary market, in the share market, you get 120. So if this one is higher than 100, of course you convert one. Then you select this one, you don't want this one. Then everything remains the same. The only difference is this one you change to 120, that's all. Can understand? If convertible, don't worry, everything remains the same. It is just that you need to compare. See, is it convert is better or you don't convert is better? It could be the case also, like this one. At the end, the share price only 4 ringgit per share, so only 80. So at the end, if you convert only 80, do you want to convert? You don't want to convert, so you get back 100. At least you can get back 100. You let the company redeem, you get back 100. Then the answer still remain the same. Okay, I think that's all for the revision I can give you. And the group can continue to present the answer.
Question B, to calculate the market value of the each 100 ringgit convertible bond. The par value is 100 and the maturity length is 5 years. The coupon rate is 9%. So the annual interest payment, we use the par values times the coupon rate, we will get 9 ringgit per annum. And the conversion value is equal to the current ordinary share price times the growth rate times the number of ordinary shares can be converted. So the current share price is 4.45 and the growth rate is 1.065 and the time is 5 years times the 20, we will get 1 to 1.94. As the conversion value is greater than the par value, So we convert to ordinary share. So the current market value of each convertible bond is equal to the annual interest times the PVIFA plus conversion values times the PVIF. We will get 123.85.
Yep, correct.
And the float value is the lowest market value of the bond. So we use the annual interest times the PVIFA plus the redemption value times PVIF. We will get 108.2.
Okay, I think that's all for the answer. Like what I have explained, well done. Okay, everything is correct there. You hold on first for this slide. So what is floor value? Okay, as you can see, floor value, it means that it's the minimum value for this convertible bond. Like what I told you all, the minimum is always at the end, regardless of the share price. Because the share price could be very high. Like in the case, we expect that at the end, if you convert to shares, based on that price, you can get 121 point something or 122 ringgit. Is more than 100 ringgit. So definitely we will convert. So the last value, the end value, is based on 122 to calculate because it's more than 100. We want the higher one. So the previous slide, if you don't mind, Sokman, can you show the previous slide? Yeah, this one, thank you. Okay, so you can see the last, the conversion value, we will be based on the conversion value to calculate the present value. Because we know that at the end, when you have two choices, either 100 or 122, you convert to share, it worth 122. We will select the 122. So that's why when we calculate, it's based on 1.94 or 122 there. As you can see, the last two line is using 121.94, but not 100. Because the share price, the conversion value of the trendy shares is more than 100. So definitely, bondholders, they are not stupid one. At the end, they will choose to convert. So the value is higher because the value of shares total up is 122, more than 100. Okay, thank you. The last slide, next slide. But what is floor value? Floor value is the minimum value you will get. So worst come to worst, even the share price later on is actually not as expected 122. You combine, maybe it's only 80 or 60 or 50 or only 40 ringgit at the end. So you will not go to convert, is that? Even the share price is very low, you still can let the company redeem the bond at 100. So which means that at the end of the day, you convert. If you convert, definitely it's better. Usually when you convert, it means that it's more than 100, so you convert. Even the share price is lower than that, you can select. I don't want to convert. I take back my 100. So at least you will get back 100 ringgit. Okay, based on the par value. So that one, if you based on that one to calculate, so the current share price, 108.20 is the floor value. Minimum, at least, it should be traded at this value. Because at least you can get back 100 at the end. And if you based on the 100 to calculate the present value, at least it's worth 108.2. So this one is the floor value. All right. I think that's all for today's tutorial. Any question for your assignment, you can ask me right now. And thank you for your presentation.